All right, it's 2 p.m., so let's get started. Hello, everyone. Welcome to another quarterly update and Q&A brought to you by the team at Apollo Crypto. My name is Henrik Anderson. I'm the co-founder and CIO. And today, as usual, I'm joined by Pratik Kala, our head of research and portfolio manager. For anyone new, Apollo Crypto is a multi-strategy investment fund manager. We're headquartered in Melbourne, Australia, and we invest globally. We have 8 years successful track record. We have three active funds and a tokenized strategy, and we are solely focused on managing a portfolio of crypto assets and strategies on behalf of wholesale investors, family offices, and fund of funds. Thank you for everyone attending today. We hold these webinars on a quarterly basis, and we also publish a weekly newsletter and also some long form research. You can find our newsletter and research at apollocrypto.com, and you can subscribe there. The purpose of this webinar is to inform our investors and followers and to provide a general update on the crypto markets and our funds. And as a reminder, this is a general discussion and not to be taken as financial advice. Please do your own research when considering an investment in the crypto markets. And as always, we're happy to take questions from the audience. So please submit any questions as early as you like through the Q&A feature, and we'll try to answer those questions at the end of the webinar. With that said, let's get started. So this is the agenda for today. We'll talk about the current market or funds. We'll talk about the outlook for crypto and how we're currently positioned, and we will end with a Q&A. Pratik, I'll hand it over to you.
Thanks, Henrik. So, without a doubt, quarter one was challenging for the crypto markets and many other markets too. But Bitcoin in quarter one saw one of its worst performances since 2018. The market continued recovering after quarter four 2025, which was also a very poor quarter. But it left a lasting impact on everything that happened at the back end of last year. Trading volumes has declined, and sentiment remained in the anxiety territories, and a lot of derivative positioning was protective for this quarter. The quarter was characterized by many failed breakouts, a lot of break-even selling, and cautious recovery, as we dipped as low as $60,000 and recovered somewhere around close to the $70,000 mark. So the period from the start of February, which is when we had a little bit of a flash crash down to 60K, we've been in the 60 to 70K range for well over a month and a half since then. There's a lot of volume being trading in that region and a lot of hands exchanging, but it's been very, very cautious sort of recovery and no immediate usual volatile Bitcoin or crypto markets movement that people are typically used to. There's also a gauge within our markets, which is the fear and greed index. It fell to 9, the bottom is 0. So it was firmly in the extreme fear territory, and it's the lowest level seen in more than 3 years. The last time we saw levels like these were when FTX collapsed. Fair to say it was a challenging quarter, and it was completely the opposite of what was happening fundamentally in the market. So it was a lot of technical based selling, a lot of leftovers and hangovers from quarter four of 2025 that was seeping into quarter one of 2026, and leading to some of the lackluster performance in crypto. It's fair to say, though, that institutional resilience continued throughout the quarter and countered crypto native bearishness. So the market today has two major players. One are the institutions, which typically express their views through CME futures or ETFs, and the others are crypto native participants that have been in the market, natively on the blockchains and operating there. So institutional resilience has been very strong, though, throughout the quarter. We can track ETF flows, and by and large, the majority of ETF holders have held throughout this volatile period, which was positive to see. Talking about the broader crypto market as well, on the right, you'll see a chart And you'll see very clearly there's a huge dispersion in returns. So it's a year-to-date performance on the right-hand side. And the top names over there are the likes of Hyperliquid, Sky, and Maple. Um, these are tokens that generate a lot of revenue and distribute it back to its token holders. So the market today is clearly in the show me the money phase. We've been very vocal about this for the last 12 to 18 months, that the market has evolved. And that is where, right now, it's no more around governance tokens or, tokens that have some crazy pie in the sky predictions on what they can achieve. It's raw show me the money phase at this point in time. And we can see the dispersion in returns on the table on the right. We see on-chain finance heating up very, very rapidly. The use cases are very clear, and a lot of stablecoin and real-world asset tokenization and volumes are heading in that direction, which is positive to see, and we'll have more slides on that later. Also, in this quarter, we saw an industry first. BlackRock and Apollo Global took their first ever direct token exposure in tokens in February. So prior to this, they weren't, they were just participating, but never actually taking positions in tokens. So it was very positive to see that in February, they were taking direct token positions within the crypto markets as well. And for a lot of the tokens in this space as well, they're rapidly adjusting their models to distribute revenue back to token holders. We've been guiding a lot of projects and tokens as well to do that. It's great to see some projects go onto that journey. And a lot of them are still working through the mechanics of exactly doing that. So market's clearly evolving and shifting and maturing with more and more institutional participation, while the previous, say, extremely volatile, lack of value accrued tokens are being washed out.
I guess looking at it broadly, it should be good for a manager like us to focus on fundamentals, revenue, and this kind of metrics. It's less of this broad-based, moves where everything is correlated, as you can see in the table here. The tokens that generate revenue, return to token holders are actually outperforming. So if you're a fundamental active manager in the space, you should be able to outperform. I think that's fair to say.
Yeah.
I guess on the positive side as well, since the war started, crypto in general, Bitcoin, I guess, and crypto has actually outperformed the equity market and even gold since the beginning of March. Obviously, it's on the back of very poor performance in the months beforehand, but it could signal that the market is bottoming.
Yeah, that's very interesting as well. If anybody's been watching the tape on Bitcoin and broader crypto, bad news did not push the price anywhere below 65K. So there was the initiation of war, the escalation of war. A lot of bad things happened in the last month and a half, but the prices of crypto remain relatively static. So it's almost that we front ran the drop in the markets and have been relatively strong throughout this volatility over the last month and a half.
Yeah, and hopefully the war is coming to an end now. At least it looks like that. So hopefully positive for risk assets going forward.
Mm.
So with that said, let's move over to our funds and just go over the funds again for those of you that are new to Apollo Crypto. We currently manage and advise three funds and one tokenized strategy. The Apollo Crypto Fund is our flagship fund. It's an Australian AUD based fund. It's done over 12.1% since per annum since inception. It's a multi-strategy approach, and what we mean with that is that it's diversified between different strategies. It's Bitcoin and Ethereum as two largest assets in this space, but it's also an allocation into our altcoin portfolio, which is the Apollo Crypto Frontier Fund. Um, and there we have a concentrated position in these DeFi assets that we talked about that generates revenue. And there's also a position into our market neutral fund, which we'll talk about as well. But that's a very stable, 10 to 15% performance in that sleeve of the portfolio. Um, so basically, what we get with the Apollo Crypto Fund is a diversified and concentrated portfolio, betting on the winners in the sectors that we believe will outperform. And it's designed to be your one vehicle for your crypto exposure. And you can see the fund composition on the right side here. So the Apollo Crypto Frontier Fund, that's our altcoin portfolio. It's a Cayman fund, a US dollar-based fund. It was launched in a very difficult market for altcoins, so it had a negative performance since inception. But it's basically a concentrated exposure again to altcoins that generate revenues, and it excludes Bitcoin and Ethereum. That's the key here. That's what we call altcoins. And It's basically a portfolio of liquid tokens. We should say also that the majority of all our investments are liquid, and that also means that we don't have any lockups in our portfolios. We have monthly liquidity across everything we do. Um, so this portfolio has a higher volatility and higher return potential than the Apollo Crypto Fund that we talked about. That is more diversified in Bitcoin, Ethereum, but also market neutral strategies. So some examples of investments we have in the portfolio is Hyperliquid, which is the largest investment currently in the portfolio. It performed really well recently. Maple, Aave, Sky, or others in the portfolio. And then our last fund offering is the Apollo Crypto Market Neutral Fund. So this is the stable um, return portfolio. We started this fund in 2020, so it's been around for 5.5 years now. It has produced 12.7% per annum since inception. Um, it's a fully on-chain portfolio, meaning that it has minimal counterparty risk. We have two basic strategies in the portfolio. It's yield farming and something called funding rate arbitrage. And the target return is 15 to 20%. I would say right now, in this market, with depressed prices, I think we are achieving something like 10 to 15%. So that's what you can expect in this market. But over a crypto cycle, around 15% plus is what you can expect from this fund. And it has, as you can see from the chart on the right, a very consistent return profile. And we've actually had positive monthly returns for 2.5 years now. The last negative return was in November 2023, where we had a month with a negative 0.5%. So very consistent and positive returns recently. And I should say there's a US dollar fund as well, the market neutral fund. It's a BVI fund. And our last offering is the M Apollo, which is a tokenized yield strategy, and it's not issued by us, but it's issued by a company called Midas. Um, so it's Midas who has issued a tracker certificate that tracks a yield strategy that is managed by one of our entities. And similar to the market neutral fund, the strategy is yield farming and funding rate arbitrage. The difference with the tokenized strategy and our market neutral fund is that the tokenized strategy um, has daily liquidity instead of monthly liquidity, and it's only available on chain. So you can swap stablecoins into the M Apollo token to get exposure to this strategy, and it's composable in DeFi for those of you who are familiar with DeFi. But you basically need a crypto wallet. So those that are familiar with crypto and comfortable with crypto wallets can access the M Apollo. Otherwise, we recommend one of our regular funds. And I'll hand it back to you, Pratik.
Yeah, thanks, Henrik. And a quick one on the M Apollo strategy as well. For anybody that is comfortable with it, I highly recommend trying it because it's gonna give you a window into the future of finance and how everything in the world is going to get tokenized and put on chain and how it makes it more capital efficient. I think for people that are already in the market, this is sort of at the forefront of innovation of how money will move in the future. And a lot of big corporates and payment providers are already moving in that direction over the last quarter. So yeah, if you have a wallet and are comfortable getting on chain, I highly recommend trying this out to get a feel of how it works.
Yeah, that's a good point, Pratik. A lot of people are talking about this kind of tokenized vaults as the future of asset management. So this is the way the industry is moving, and yeah, you can access it today on Midas.app.
Yeah. So coming back to our quarter one and the crypto markets and Bitcoin practically underperforming and suffering. I want to take a route back and talk about the fundamentals, right? There's one time when the market prices are depressed and the fundamentals are depressed and it's all looking very grim. But we're in a market where the fundamentals have never, ever been better, but the market prices are severely depressed. So there's a huge difference in what the fundamentals and what's happening underlying in the infrastructure in the hood and on the regulatory front versus the sentiment. Crypto has always been extremely volatile, and people want instant 2, 3, 5x's, and people got a chase and thrill out of it. But the market is now maturing, and it's important to notice that we are now focused on very strong fundamentals, which sets us up for a multi-decade sort of run on quality assets. I want to talk about a few in quarter one of 2026 and some of the big ones from last year. So the first one was in February, where the SEC cleared 16 digital assets as commodities. We've been talking about this for a while, but this has finally been rubber stamped and pushed through. And this includes the like of Bitcoin, Ethereum, Solana, XRP, and so on. So all banks, all brokers, every other institution can do things with these assets now without the fear of the SEC claiming that they're dealing in securities. The second one is the Clarity Act. Once this is signed, it will become the single biggest de-risking event for institutional capital since 2024 when spot Bitcoin ETFs launched. So when spot Bitcoin ETFs were being launched in the US, I think it was a 10-year journey. I mean, there were firms that wanted to launch it in 2015, and they didn't come around to launching it till 2024. The Clarity Act is supposed to provide, for lack of a better word, clarity to the entire traditional finance ecosystem on how to participate within crypto. And that's expected to pass anytime soon. Crypto soon will be eligible in 401ks, which is the US pension system. And then the following 3 to 4 bullet points are all large investment banks, asset managers, turning on crypto within their platforms, allowing their advisors to sell crypto products within their platforms, lifting any restrictions, providing insurance, providing a lot of things around crypto. So a lot of the fundamentals are shaping up really, really well. In fact, the best that they've ever been in crypto's history. But of course, yeah, the price has been in the opposite, has moved in the opposite direction. These are the sort of exact setups to position around. So regulatory clarity will beget product proliferation, and then that would beget inflows into the asset class, and that would beget into valuation re-rating. So right now, the sentiment from Q4 and Q1 is very grim. As we saw in the Fear and Greed Index, the performance is down quite a lot. But fundamentally, we've never seen better support to the entire asset class since the inception of crypto, really. So positively, quarter one was a hard reset in prices, but all the fundamentals, the infrastructure that got built, all the regulatory things that got passed should set us up for a good 2026, in my opinion. And one thing that is on the forefront of a lot of people and headlines is the quantum risk. So what you see on the right-hand side is not a fancy chandelier or a lamp. It's actually a quantum computer from Google. There's a lot of headlines now talking about the existential risk to Bitcoin because of quantum computers. And we've done a lot of work in understanding that, and consulted with a lot of people, and it's quite clear that it is not a current thesis driver, but it could become an issue over the longer term. So what is the longer term? It is anywhere between 5 to 20 years. So sufficient time for us to resolve some of these issues. So today, cracking Bitcoin's cryptography would take around 500,000 physical qubits, qubits standing for quantum computing bits instead of the binary ones and zeros that we're used to today. And Google's Willow, which is one of the latest and greatest advanced chip today, can only do 105. So you can see that this is a huge step change. So the most advanced chip would still take many exponential rises in advancement from here to get to a position whereby it can, be able to attack Bitcoin or crack Bitcoin. Of course, there will be other issues at that point in time because a lot of legacy institutions and our nuclear infrastructure and other things are still on the similar encryption standards as Bitcoin, but focusing purely on Bitcoin, that's still multi-year risk, not something immediate as mainstream media might make you believe. And also, what is Bitcoin and crypto broadly doing to resolve this? Well, quantum proof technology already exists. There are three standards out there. So it's all a matter today of consensus on upgrading the Bitcoin network. There are multiple ways to do it, and the community and the broader Bitcoin participants and investors are engaging actively on how to resolve this, and reasonably confident that we will come to a solution and upgrade the network in a few years. So not a current threat as mainstream headlines would make you believe. And even with the exponential rise of AI and other technologies, getting to a point of quantum compute that will be able to crack the network is still many years away. To you, Henrik.
Thanks for that, Pratik. So I'm going to talk about a few different trends and what we're seeing currently in the market. So some of the biggest, I guess, narratives and what's actually happening is that financial institutions are moving into tokenized products. We talked about asset management moving on chain to vaults. There are also a lot of real world assets being tokenized. So that's one big trend. The other big trend we'll talk about briefly is stablecoins that we talked about before as well, which is a form of tokenization, but it's being used for more and more payments, FX, etc. But just looking at the tokenization and the growth, sometimes it can be good to zoom out, and this is looking at the last 5 years. So starting with stablecoins, it's up 400% in the last 5 years. There are currently $300 billion of stablecoins outstanding, and we think this will continue to grow exponentially to the trillions of dollars in the years ahead. So payments, as I mentioned, is one use case. FX is another one. We will also talk about AI and how they can use payments in the future. But there are a lot of institutions talking about stablecoins as the future of payments, as they can be sent anywhere in the world instantly, almost for free. So that can unlock a lot of efficiencies. If you go to the bottom left chart, it shows the tokenized commodities market cap. So this is other real world assets basically coming on chain. Last 5 years is again up over 3,000%. And especially, I would say, in the last 6 months, we have seen a huge increase in the interest of trading and holding tokenized gold on chain. So currently it's almost $6 billion in tokenized commodities on chain, but it's rapidly increasing as well, and will probably continue to do so. This is just tokenized assets. There's also trading of these assets happening on chain. So I mentioned Hyperliquid before. That's a exchange where you can trade perpetuals or futures, and they're seeing a lot of interest now in gold markets, oil markets. They are some of the most traded um, perps now on Hyperliquid. Um, all right, moving to the top right, that's the tokenized fund market. So you have things like Sky's yield-bearing stablecoins. You have things like Athena's yield-bearing stablecoins, Maple one as well. So this is basically so far people who look for yield and they can get really good yields in some cases on their stable coins on chain, and it's accessible basically to anyone in the world with a mobile phone and an internet connection. So it's really democratizing investments. And or MAPolo, that's basically a yield-bearing token. It fits in this category as well. On the bottom right, you have the tokenized stock market, which has really been taking off in the last 6 to 12 months as well. It's up 5,000% in the last 5 years. And you currently have around 1 billion sitting in tokenized stocks on chain, trading 24/7. Again, democratizes access. And we see some of the biggest exchanges in the world, like New York Stock Exchange, Nasdaq, starting to make moves in this space and looking to tokenize some of the assets that are trading on those traditional exchanges. And this is um, supported by the SEC and the US government. They are seeing more and more financial assets moving on chain. So this is a very big trend um, and basically a real world use case of blockchains that we've been waiting for many years. The infrastructure, as we said, is built now, and now it's finally starting to happen. Um, and just want to highlight one of our portfolio positions as well, called Pre-Stocks. And what they do is that they tokenize pre-IPO equities. So that's stocks like SpaceX, OpenAI, Anthropic, and Polymarket, and others. Um, Basically democratizing access. You can make them liquid. You can trade them on Solana 24/7. So this is a fantastic use case, I think. And in the last 6 months or so, they have seen $622 million in volume, and they currently have over 13,000 holders of these stocks on chain. So I think this is a fantastic use case. Um, and yeah, it's good opportunities if you want early access before they get listed on an exchange. I think there are some expectations that SpaceX and OpenAI, for example, will list in the US this year, but you can already access these stocks on chain. Finally, I want to talk briefly on stablecoins. We have talked about stablecoins a lot the last few years, um, but I think AI is on everyone's mind. And I think actually stablecoins in crypto could be um, very synergetic because AI agents are becoming more and more autonomous, and they can't really open a bank account. So how will they transact? I think crypto is the natural way for them to transact, and especially with stablecoins. So you will have AI agents working for you, booking restaurants, booking trips, hotels, etc. And they need a method to pay. Um, and there are a new standard for AI payments. It's called X402. So this is something we are monitoring closely. Basically, what this new standard does is that it enables instant low-cost payments for digital services, and it's kind of the perfect use case for agentic commerce. And on the chart to the right, you can see kind of how it's really taking off currently. Still very, very early days, but potentially a lot of growth ahead.
Yeah, on the agentic payments as well, crypto fits in perfectly there because you need an open platform, just like the internet, to be able to make these payments streaming between agents around the world. I think when we started, most people thought that, okay, everyone's going to have one PC in the 90s. And now each one of us would have anywhere between 3 to 5 devices, be it smartwatches, laptops, mobile phones, iPads, and other smart devices throughout the house. In many cases, each of these devices have to talk to each other. And if you've been monitoring OpenClaw and how people are spinning up their personal assistants and personal booking agents, you can completely see that being a situation where every person would, like, just like they have 5 devices today, would have 5 to 10 agents operating on their behalf and paying each other and moving around and doing transactions on their behalf. So I think this is a key trend to watch, and I think it fits in very beautifully into what crypto and the infrastructure that is being built and on open standards versus a CBA to NAB payment and bottlenecks there, as this would be a global sort of platform that would need to service something like that. Yeah.
All right, I'll hand it over to you, Pratik, for the last slide. Before we
Yeah,
move to
thanks.
Q&A, so just a reminder again, if you have any questions, put it in the Q&A feature.
Yeah. So portfolio positioning, nothing's changed from the last quarter. In terms of our strategy, we still run a concentrated portfolio in high conviction projects, very focused on verifiable revenue and a clear product market fit. We're focused heavily on liquid strategies rather than primary deals being VC style early stage deals. We are currently generating superior yield on the majority of assets in our portfolio. Most of our assets are mostly 100% staked, so we're generating yield on all of them. And below is a list of projects that we are highly convicted in today. I think we've talked about some of these already. Hyperliquid is a clear category winner. If you read Bloomberg frequently or one of the major news sites, I think you will start seeing Hyperliquid a lot more, especially in the last 2 months. The oil market predominantly was being traded on Hyperliquid on weekends as Trump and Iran went up and down over the weekends. Most traditional markets were closed, and Hyperliquid was where you could clear $300 to $400 million per day worth of volume on oil. So it was very popular and frequently referenced by Bloomberg and other major financial sites. So very interestingly, also yesterday when the market was closed, the ceasefire deal was announced. And on Hyperliquid, you were able to see the price reflect that pretty rapidly with a drop in oil about 14 to 15%. And then when the US markets opened up, I think the prices stabilized and leveled to effectively where the Hyperliquid traders were pricing it at. So very big and successful use case of the nature of crypto and how it's operating at the moment. Sky is one of the largest stablecoin issuer, has very strong earnings, is running a very good investment sort of process and generating a lot of yield and distributing it back to its token holders in terms of really strong yields. Syrup is similar to Sky in that sense, with a different model. It's got over-collateralized loans, also a reasonable position with the portfolio. Jupiter is a very diversified on-chain business. They dominate on Solana. So they're not focused on one vertical, but they're focused on multiple, from borrowing, lending, to routing, to trading, and they're very well diversified with strong revenue. So another position in our portfolio. And Derive is a new addition. It is the largest options venue on chain today. As we see more and more people go on chain and more tokenized funds and vaults and what have you, we think there's a natural fit for options and the volumes of that to come on chain as well. And we think Derive could benefit quite well from those tailwinds. So no changes in the portfolio, in the core portfolio strategy. We think this is what works in the current market, and relative returns would indicate that as well. And over to the Q&A. Happy to have any questions nothing's off topic, so ask anything.
Yeah, thank you for that, Pratik. Do we have any questions? Let's have a look. We got one question here from Thomas. Is agentic AI inseparable to cybersecurity? What steps have you taken to protect your infrastructure? Okay. Agentic AI, is it inseparable from cybersecurity? Well, a few different angles you can talk about that, I guess. One is the very frontier AI models. They can find security holes in software. So it becomes very important for DeFi protocols, especially to have time logs, these kind of things. The DeFi protocols themselves will increasingly use AI as well to make sure they don't have bugs in their code. We use institutional grade infrastructure and multi-signatures for everything we do. I don't know, Pratik, do you have anything you would like to add to that?
Yeah, I think the question with agentic AI and cybersecurity, it's conflating the two. They're sort of separate, but in terms of taking steps to protect our infrastructure, we are using institutional grade cybersecurity practices and processes. So we use Fortify as our custodian. Everything requires multiple face IDs from the team. Any smart contract we interact with requires a thorough whitelisting process. After we get the contract address, the whitelisting, the address is double checked with Fortify's internal security as well. There's a service that they run to double check that. We have extensions such as, DeFi Llama is very good extension that allows us to check if we are on any risky sites. So we have multiple steps in protecting our infrastructure and ourselves when interacting within this space. Rest assured, I think we have been running an on-chain fund for many, many years now, and we're well aware of the pitfalls of many things within crypto. So very well secured in our perspective in that sense. Nobody can magically get into our infrastructure and withdraw money without explicit, biometrics coming from at least 3 members in the team. So I think that should hopefully give you some confidence on the protection of the infrastructure and the steps we take internally. I see the next question. Maybe I can take it as well. Do you see mostly retail participation trading these tokenized assets? Yes and no. I think the tokenized funds, they're sophisticated people that are trading tokenized funds. Talking about mApollo, I give this example to everybody. Say you are invested in our wholesale fund, and say you put in $100,000 into our fund. For all intents and purposes, that money is in the fund, it's locked, and when you redeem it, you get a CGT event and you get the capital gains and returns. However, if during that process, maybe you invested for a year or 2, 3, if you ever wanted to withdraw, say, just 20 grand or $30,000 for like some short-term cash needs or trip or renovation, it's sort of impossible to do that without waiting for 30 to 60 days and a lot of paperwork and triggering CGT. The tokenized funds that are coming on chain, and that's why BlackRock and Apollo Global and everyone's so keen to get into this space, allows you to get that $20,000 in practically 5 seconds. You will have the tokenized representation of the fund. You will go to a lending market such as Morpho. You will say, hey, here's my units in the Apollo fund. I want to draw $20,000 against it, and it'll be in your account or in your wallet in 5 seconds. It's as simple as that. No long-term waits, no CGT, no triggering of any of those things. Very, very capital efficient. So tokenized funds, I think we're seeing a lot of sophisticated people participate in them. As for tokenized equities, I think we're seeing a lot of retail go in there. So people that are locked out of the US markets, many people all around the world want to access the likes of SpaceX or OpenAI in private markets, but they cannot because they don't have access to SPV structures. they would get on chain and try accessing them through crypto rails, which was the original sort of intent of having a decentralized system out there, allowing everyone fair access to financial products. As for tokenized equities as well, a lot of people are accessing them um, that are retail. But the funds, so the two cohorts, the funds are normally sophisticated investors that want to borrow, lend, and do a lot of things like that. And then the individual tokenized equities and so on have a heavier retail participation. But I think they're all going to come in together because of how what I just explained. If you have any stock, whether it be CBA, BHP, an ETF, and you want to borrow against it, it's incredibly difficult today. And when that comes on chain, you should be able to do it in 5 seconds. So that's the future, and that's where it's heading towards.
Okay, great. I think the next one you're well situated to answer as well about BitTensor and Tau. There's also a follow-up question to that one about Canton Network. So maybe you can take those two, Pratik. I know you looked at extensively at those two protocols.
Yeah, yeah. The clear answer to invest in Tau and its subnet, the answer is no. I've looked at Tau. I've looked at its subnets. I've spoken to the teams of some of the subnets. I've spoken to some of the members of Tau. And I know it's recently become popular because Jason Kalankalis from the All In podcast is talking about it. I think we've done the work. We've read the white papers. We've seen the subnets. And the conclusion I draw is it is an incredibly complex thing to wrap your head around in terms of how the value will ever get back to a token holder that is holding Tau or any of its subnet tokens. The headlines would make you believe that the subnets are superior to AWS cloud systems or Claude models, but they are being heavily subsidized by Tau emissions. And if you strip away the Tau emissions, they are a factor of 10 to 20 times more expensive to run than your regular models in the cloud. So I think we're not looking at it. I mean, we have looked at it multiple times over the last year and a half and spoken to multiple teams in the area. And we just haven't been able to get the confidence to underwrite any position in that in size. So yeah, hopefully that answers your question on Tau. And you also wanted to talk about Canton. Also spoke to Canton and the Canton team and members. It's a very interesting chain and project as well. Again, there is some questions around where's the cash being generated and how it's distributed back to Canton token holders. And there's also a problem, in my opinion, over there with the equity versus token value accrue. Canton was created by its parent company called I think it was called the Digital Asset Company. They were working on the ASX project as well for people familiar with that. And so there's an equity portion of it, and then there's a token portion of it. And strictly speaking, if that network is making money or the technology is making money, who gets it is the question. And I think it's the equity holders that might be accruing value there and not the CC token at this point in time. We assess these positions very regularly. So every month, I would re-look at all of these and speak to the relevant teams to see if anything's changed. And I think our last assessment was, Canton's building some good technology, but the value accrue is still a question mark at this point in time and who gets it. So hopefully that answers that question as well.
Okay, fantastic. I think there's two other questions, and yeah, if you have any other questions, just put them in now as we are wrapping up. But really good questions. And another question is any plans for RWA, that stands for real world asset perp trading, hyperliquid, CME, oil strats, hedge with borrows. So this basically asks about yield strategies we can do when there are more assets available, and absolutely we look at all the different yield opportunities out there. So that's definitely something we're actively doing. And the last question is any impact on Apollo from Drift protocol hack? In general, would this have been covered by Nexus Mutual? So Nexus Mutual is insurance protocol company where you can insure against different type of security incidents and hacks. Drift protocol was a It's a perpetual protocol on Solana. They got hacked very recently in the last week or two. We didn't have any exposure to Drift, so no exposure from there. Um, with Nexus Mutual, I'm not sure if they had insurance for Drift. I haven't heard anything, so I think probably not. Is the answer there? But yeah, no exposure from Drift protocol hack on our side. Have we got one
Neat
more
question.
question? Yeah.
Yeah, it says price prediction for hype by the year end with HIP 3 and 4. I mean, I'm loving these questions because they're very like in the weeds. They're clearly the anonymous attendee is deep in the order books on some of these, so in our industry as well. So price prediction for hype, look, it's very difficult to make price predictions. They always get thrown out with anything Trump or Trump can do or anybody else can do. So very hard to make a price prediction. But what I can say is hype is one of the clear revenue winners of this industry. It's 99% buyback of a very strong protocol, and its value capture is not only strong, but the network effects are very strong as well. I use Hyperliquid a lot. A lot of the people I know use Hyperliquid a lot. A lot of people that were using other exchanges have moved to Hyperliquid specifically to do the real world assets trading. So as that volume grows, it is going to continuously, generate more fees and then buy back more of its tokens. So I think it's got a very strong floor under it, and any dips would be swiftly bought because of the way it's structured. HIP 3 and 4, again, phenomenal. To be seen how they compete with, for people that don't know, that for 4 is prediction markets. So you could like Polymarket and Kalshi, you can bet on outcomes on certain things. So I think that they will also be, it will be very successful on Hyperliquid as well, to be seen if it is going to be as successful as Polymarket and Kalshi. But overall, because of Hyperliquid's design, any volumes that go there, any fees that are generated go back to buying back the Hype token. So overall, very bullish on Hyperliquid. As we mentioned, it is the largest position in our altcoin fund and has done phenomenally well since the start of the year. One comment from Bell saying hype to $300. I mean, I hope so, but it's 6x from here. If you look at the FDV value, it'll be very rich. So I think it'll be a long way to get there, but I hope you're right. But we can definitely see a multiple from here over the next few years. And a follow-up question to that, do you think Lighter and other comps will eat into some of the market share, or hype is moving too fast? Good question as well. I think they're attacking it differently. Hyperliquid, in reality, is offering a lot of products that is non-KYC, non-AML. It is by design, and people love it for that. Hyperliquid has now got an arm to get some sort of regulatory clarity and maybe have a US-based exchange. The way the world works is ultimately Uncle Sam's going to come and demand its taxes. So if the hyperliquid volumes for real world assets, especially US assets, get to a certain point, you will see somebody from the US or the US tax office come around and say, hey, we want some of our money on all the money that's being made on your platform. Lighter, on the other hand, is taking a proper and regulated approach, US domicile, US listed, and will be able to comply with those regulations better, and is working closely with Robinhood on a bunch of those things. So different verticals. Hype's going for the house of all finance. Everything has to be decentralized. No KYC, AML. Just people should be free to do what they want. And Lighter is taking a similar approach today, but I think over the long term they would want to be more US focused, domiciled, and regulated. So sure, I mean, if you look at relative comp, Lighter is severely undervalued, but at the same time, will it be able to attract traders, and volumes is the question. And there's Ostium and a bunch of other ones as well for people that are in the market. So lots of competition there, but Hype is a clear dominant winner, and seems like it will continue for a while.
All right. Really good questions today. And I think we'll can wrap it up there. And yeah, thank you everyone participating, and we'll see you at the next webinar.
Okay.